Welcome. Today we're diving into the world of financial markets to answer a simple but important question. What exactly is a rally and why does it happen? Whether you're new to investing or just curious about market movements, understanding rallies is key to making sense of those sudden surges you see in stock charts. In this video, we'll break down the concept, look at real-world examples, and explore the reasons behind these dramatic upward moves. Let's get started by defining what a rally actually means in the context of finance. Rally refers to a period when the price of an asset, such as stocks or commodities, rises sharply over a short time. This isn't just a small uptick, it's a noticeable sustained increase that often grabs headlines. Rallies can happen in individual stocks, entire sectors, or even across the whole market. They're the opposite of a sell-off where prices drop quickly. Understanding this basic definition sets the stage for exploring why rallies occur and what they mean for investors. Rallies come in different forms. There are bull market rallies, which happen during an overall upward trend, and bear market rallies, which are temporary surges in a generally declining market. Each type has its own causes and implications. Recognizing the type of rally is important for investors, as it can influence decisions about buying or selling assets. Let's look at some examples to see how these rallies play out in real markets. Imagine a period when the economy is strong, unemployment is low, and companies are reporting solid earnings. During such times, investor confidence is high and stock prices often rise steadily. This is a classic bull market rally where optimism drives prices higher and higher. Investors feel encouraged to buy, expecting further gains, which in turn fuels the rally even more. Now picture a market that's been falling for months. Suddenly there's a burst of positive news, maybe a government stimulus or a promising economic report. Prices jump sharply, but the overall trend is still downward. This is a bear market rally, a temporary surge within a longer-term decline. It can be confusing as it sometimes gives false hope that the downturn is over. But what causes a rally to start? Often it's a combination of factors. Positive economic data, strong company earnings, or even changes in government policy can spark investor optimism. Sometimes it's simply a shift in sentiment. When enough people believe prices will rise, their buying can create a self-fulfilling prophecy. Let's break down these triggers in more detail. New economic reports show growth, like rising GDP, lower unemployment, or increased consumer spending. Investors often react positively. These signs of a healthy economy can trigger rallies as people expect companies to perform better and profits to rise. The anticipation of future gains leads to increased buying, pushing prices up quickly. Strong earnings reports from major companies can also ignite rallies. When a well-known business posts better than expected profits, it often boosts confidence across the market. Investors may rush to buy not just that company's stock but others in the same sector, leading to a broader rally. This domino effect can quickly lift prices across the board. Sometimes, government actions like lowering interest rates or announcing stimulus packages can trigger rallies. These policies make borrowing cheaper and put more money into the economy, encouraging spending and investment. Investors often see these moves as positive signs, leading to a surge in buying and a rapid rise in asset prices. Market sentiment, the overall mood of investors can change quickly. Sometimes all it takes is a wave of optimism or a belief that the worst is over. When enough people start buying, prices rise, attracting even more buyers. This feedback loop can create a powerful rally even if the underlying fundamentals haven't changed much. Another cause of rallies is short covering. When investors who bet against a stock see prices rising, they may rush to buy shares to limit their losses. This sudden demand can push prices up even further, creating a sharp, fast rally. Short covering often adds fuel to rallies that are already underway. Technology plays a big role in modern rallies. With online trading platforms and instant news updates, information spreads quickly. Automated trading algorithms can react to market moves in milliseconds, amplifying trends. This speed means rallies can happen faster and be more dramatic than ever before. Human emotions are a powerful force in the market. Fear of missing out, or FOMO, often drives people to buy during rallies, hoping to catch the wave before it's over. This herd mentality can make rallies even stronger as more and more investors jump in, sometimes without fully understanding the risks. The media can also play a role in fueling rallies. Positive headlines and expert commentary can boost confidence and encourage more people to buy. News coverage of rising prices often attracts new investors, creating a cycle where media attention and market gains feed off each other. High trading volume and liquidity make it easier for rallies to gain momentum. When lots of buyers enter the market, prices can move up quickly without getting stuck. Liquid markets allow for rapid transactions, which helps rallies build speed and reach higher levels. Major global events like breakthroughs in technology or international agreements can spark rallies. When investors believe these events will lead to economic growth or stability, they often rush to buy assets, driving prices higher. These rallies can spread across markets worldwide, reflecting the interconnected nature of today's economy. Rallies aren't limited to stocks. They can happen in commodities like gold or oil and even in cryptocurrencies. Each market has its own triggers, but the basic pattern is the same. A surge in buying leads to a rapid rise in prices. Understanding this helps investors spot opportunities and manage risks across different asset classes. Rallies can last anywhere from a few minutes to several months, depending on the underlying factors. Some are short-lived, sparked by temporary news, while others are part of longer trends. It's important for investors to recognize when a rally might be running out of steam, as prices can reverse just as quickly as they rose. While rallies can offer big gains, they also come with risks. Jumping in too late can mean buying at the top just before prices fall. It's important to stay cautious, do your research, and avoid getting swept up in the excitement. Smart investors look for signs that a rally is based on solid fundamentals, not just hype. History is full of famous rallies, from the dot-com boom to recent surges in tech stocks. Studying these events can teach valuable lessons about what drives rallies and how to navigate them. By understanding past patterns, investors can make better decisions when the next rally comes along. Sum up: a rally is a rapid, sustained rise in asset prices, driven by factors like economic data, investor sentiment, and global events. While rallies can be exciting, they also carry risks, so it's important to stay informed and think critically. By understanding what a rally is and why it happens, you'll be better prepared to navigate the ups and downs of the financial markets. Thanks for watching and keep learning.